Good evening, ladies and gentlemen. This is Clueless Trading Frank. It's approximately 8:11 p.m. on a cold evening out here in the New Jersey, New York waterfront. It is the 10th of December, 2018. This is a very important strategic weekly update, as I normally do on Sunday or Monday evenings, then one more during the week, which keeps people grounded on what's going on. And then we can basically figure out in between what we need to do through the real-time Twitter feed, which delivers some very precise and accurate and actionable. That's the most important part, the actionable trading charts, which day and swing traders can use to make some real decent money, as we saw today, among many other days that we've been doing this consistently. So, saying all that, full disclosure, this is purely for financial education, not for any solicitation or advice, and we shall begin. This session will be uploaded to the Clueless Trading YouTube channel, and for all members to view at their own times, as well as anyone else who might be visiting us, do check us out on the Google YouTube channel for some very powerful and predictive and accurate video blogs, what we call videocasts. So feel free to pass the word around and check us out. On that note, let us begin. A couple of broad points here. What we're going through right now and what we have been going through pretty much all year, but more so now, which is very similar to what we went through in the first part of the year. In the what you're looking behind you is obviously a chart of the market through the eyes, through the framework of the S&P E-mini S&P 500 index futures, is a very similar type of volatility that we incurred back from months of January, end of January, to pretty much this period, which ended around April, and then a double bottom, almost a double bottom on May 3rd. Since then, we went up on a rolling ride up. Lots of consolidation channels, but the volatility was the volatility range on the VIX was smaller. What we're going through here is what we went through there. Now, will this be a replication of what happens over the next couple of months? I have no idea. What I can tell you is I am a pattern specialist. I've specialized in recognizing pattern symmetries. I've always said, and I'll keep on saying, that every crisis is the same for different reasons. Market reactions are pretty similar. What I will tell you is the speed and the velocity of the movements that we see every day when we wake up every morning is absolutely fast and furious. That's the best way I can describe it. These are algorithmic high-frequency trading programs that you've heard me say thousands of times for many years. Now you're seeing them in action. These are not the retail investor controlling the market. These are machines, bots, black boxes, and very fast trading computers known as HFT, high-frequency trading, that are moving with the markets. Saying all that, my charts, which I lay out for you guys every single day, show you the glide path and the roadmap that you need to have, and you can intraday make anywhere from 40 to 60 to 100+% on intraday calls or puts, depending on the directional bias on the market, which changes on both sides as we move along. Case in point today, case in point of what we saw on Friday, and many, many days during the week. We were down heavy, 500-600 points, and then we ended up positive. So these are not things that happen in a random fashion. These are mathematical algorithms that are moving and trading levels, and that is exactly what I show on my charts. By now, all my members, I'm sure, are reasonably well versed on how to read my charts. But more importantly, if you're not, I always highly suggest that you work with me on the advanced coaching sessions, like many do, and you certainly see the difference that it makes on maintaining your profits, minimizing your losses, and be more proactive in attacking the markets and making some serious money, regardless whether it's a long trade, a short trade, regardless of the volatility. And I'm proving that every single day. Now, saying all that, an average retail emotional trader, what we call RETs, will not be able to survive these markets. That's the reason why why during these very extremely volatile times in stressful markets, which are being rocked around by many different factors, which I lay out very openly in simple terms, explained it many times. Today, for example, was the Brexit play on what was going on in the UK, delay of the parliamentary vote, which is one reason. The average retail emotional traders cannot survive these markets. And that's the reason why we see during this times of duress in the markets, stress in the markets, some of them drop out. But I believe that my members, my loyal members, are not average traders. They are trying to get themselves out of that box of being scared all the time, taking some small trades, making some decent money, losing less, not panicking as much. And I see the difference happening with a lot of people, especially the people who work with me on my advanced coaching sessions. They certainly can attest to the fact that they are seeing things a lot more clearer when they are trading these very precise tactical charts, which might look like a big maze like a matrix for the untrained eye. But each of these levels, each of these lines, each of these patterns is, honestly speaking, from a trader's perspective, from a tactical trader's perspective, is money in your pocket. Not to say that you're not going to be down one day, of course. You set up a trade, it goes the other way. That's the nature of the beast. But net, you can take advantage of each of these candles on a 15-minute, this is being a 1-hour chart, on a 1-hour chart basis. And these 4 candles today, starting off with the big hammer reversal of 2583. Culminated in more than 100% more than 100%. The SPY calls, as you know, the 266s, the 264s, they went from a low of about 95 cents to $2.60. That's not a joke. That's like saying you bought a call for $9.40 and you sold it at $25.90. That's really what happens. It went from 94 cents to $2.80. I'm sure nobody really caught the 94 cents. Let's call it the dollar. You're still looking at a 90 to 95% ROI in your pocket if you stay somewhat disciplined. And the only way you can stay disciplined, mentally disciplined in this type of market is in these type of extreme volatility markets is by trading these charts. The more you try it, bits and pieces, try it with larger money, try it with smaller money. I'm not here to tell you how much money you want to try it with. I would suggest you try, for newer traders, to trying it with smaller amounts of money, buying fewer calls. These SPY calls are pretty damn cheap, at 90 cents, at $1.20, they're not going to break the bank. You start to gain a level of confidence that allows you to basically take the next trade and sell at levels that are pointed out, and then basically going from there. Now, saying all that, I will tell you, and this is it's a fact, and we know that, is that the Globex movements, which is after the market, overnight, or even after the market closes. The futures are down 14 points right now, right? Futures are down 14 points right now, as I can see. Now I'm kind of skimming through the charts here. These are the short-term charts, the 1 hour, the 15-minute. You cannot control those. So you always have to have some level of cash on the side. Or you might want to just, when you're in a big day like this, when we catch this big flow right off the bottom, which we have done repeatedly, many days, you might want to cash out, and I'm not telling you what to do exactly, that's up to you and your risk level. You might want to cash out all of it, and put all of it in cash so you can use it the next day. Or you might want to take out 50% of it or 60% of it, and then leave cash on the side, because you need to have cash on the side in order to take advantage of this extreme volatility. No question about it. No question about it. Waking up in the morning, looking at futures at 4 in the morning when the European markets open, or the Chinese markets open at 9 p.m., Asian markets open around 7 p.m. Eastern time. You know what? It's a crapshoot, because regardless of how precise these charts are, at least I'm showing you the roadmap where things can fall and where things can rise, to try to game the level of where the S&P futures are going to be, where the market's going to open the following day, is a fool's game. This is really what we're going through. It has many different factors on it. I've mentioned it before, and I'm not going to go into it today. Okay, there are liquidity factors, there are foreign exchange factors, dollar, yen, there are political event factors, news coming out of China. There could be Chinese economic numbers coming out. Wake up in the morning, European numbers coming out. Mario Draghi, the the head of the European Central Bank, I believe on Thursday will be holding its meeting. His comments will have, market moving effects. How whether or not they're going to how quickly they're going to close down the quantitative easing that they've been doing, as in liquefying the markets, which we were doing a couple of years ago, and then we are now quantitatively tightening as we're raising rates. You might be saying, hey, we're looking to raise rates. So all that stuff has a direct effect on the Globex markets. That's overnight, futures markets. So we won't be able to tell what that happens. What we do have control over is what happens during the day. So that's really where I'm coming in. We have the bigger picture. You're looking at a daily picture. We're going to go through these charts very quickly. That I keep on showing and walking you guys all through it. We make some sound mathematical probability forecasts as to what might happen depending on different indicators that we're looking at. The simplest ones that we look at are the stochastics, the McLaren oscillator, things like that, whether they're deep oversold, whether they're overtly overbought, extreme overbought, and we can make a probability forecast as to what might happen over the next couple of days. But we cannot, given this extreme volatility that we are incurring, make a exact call like was possible a couple of months ago during this phase, for example, that where the futures are going to open up the following morning. Okay, so as long as you accept the facts of reality, then you'll be able to survive this battle. That's just the way it is. You cannot bend reality to your own liking. We all would like to, but we can't do that. We have to work with the cards that are in our hands. We're sitting at the table. We got to play the game. That's it. All right. So on that note, let's start off with the daily charts. And and a big reminder: I put some very relevant articles that I post, which I feel that my members will find useful. And I know many of you click it, look at it, and the ones who don't, I suggest you do, because an educated, informed investor or a trader has a higher probability of generating profits in all types of markets because they're well informed. It's important, right? So please do that, and you will see the difference as you move along. The topics can be dry. You can scan the headlines, quickly look through the article, look at a couple of lines. As you look at it more, as you read more into these articles that I put through, believe me, my service is giving you a very rounded approach, a very knowledgeable approach on how to attack the markets. So combine it with the charts, combine it with your own gut instincts, combine it with your own opinions of what might be going on, which most of the cases really doesn't mean anything. My opinions don't mean much. It's a matter of following the tactical charts, but mix in the whole hodgepodge of it in the melting pot, in the boiling pot, and then you are at least in a far better position, stronger position to manage your trades. Common sense, apply it. All right. Now, so this is the daily chart of the this is actually the S&P 500, and let's go through that. What happened? So this is 2018. This is where it started. We all know that by now. There's a couple of times I have noticed, and this is called pattern recognition, where the candles have long tails. One was back on February 9th. 1 second, right there on February 9th, when the world was falling apart. February 9th. Look at the length of this tail. That was, I believe, a 600 to 700 point reversal on the market. Okay, right there. Let me change the color. So this is all technical stuff. So right there, with a long tail reversal. This was a short tail reversal. Look at this length of the tail. This was a long tail reversal. Not as long as this. The longer the tail of the reversal, simple. That means that means a very large amount of short covering occurred. That means the amount of money that went into the short covering programs and the new buyers who came in following that tail was quite large. So you have to respect it. It is, after all, about money flow. More buyers than sellers, right? It's the way it goes. So bottom line is, very long tail, lots of money went in. Here, moderate. Here, a reasonable size reversal with a small, with a small head. That means, that basically means you want the body of this candle to be a little thicker, like this. Now, this you can apply to all different charts you're looking at yourself, stocks, and believe me, these things work. The fatter the body of the candle, that means the money stayed there. It didn't just pull out. Okay, so it's good. I'm explaining to you in very simple terms, like I'd explain to a 5-year-old or a 10-year-old. So the best way is to keep it simple. So saying all that, we had a long tail reversal here that was on. We'll zoom in, clean out the mark. So we saw this one long. You guys see that? This one was a reasonably good size, but this has a higher probability of creating a multi-day swing. That's exactly what it did. Very large, 1,000 plus, 1,200 plus points on the Dow. Not looking at patterns, so we're focusing on candlesticks right now. There's one 3-day rally. Here's one small. You can see that 2-day rally, including, if you take into account the money that's been made from the lows on that day, then you're looking at some pretty substantial gains. This was a small. This candle wasn't anything to write home about, but it created a multi-day rally because it was coming off a powerful pivot point, which is the 2018 break-even level. Remember, the 2018 break-even level is this magenta line here. That's why I say 2018, and that is sitting approximately at around 2680. Around 2680. Okay, that's why we have this as a reference point. This chart, as you can see, it's pretty obvious, is really for swing traders. You want to mix this in with the 15-minute, the 1 hour, and you get an idea whether or not the rally is sustainable, or at least sustainable for the time being, because things change so fast these days. At least you can say, okay, I'm seeing the candle expansions. I'm showing that. You use your own judgment. You want to stick with some sort of swing trade as you move along. So when you look at the tail formation, there was one here. Putting up the support line here, which was off 2600, 2603 or 2605. Look at the number here, 2605, and that occurred on the 29th of October. Now, today was interesting because we went and retested the March 3rd lows, and we retested April 4th, and we retested not the lows, but we retested February 9th. So Feb 9, because remember, we went down to 2583. So 2583 was February 9th, April 2nd, April 3rd, April 4th, almost April 6th, May 3rd, then we fast forward, October 29th, and that is the pattern that's being played out right now. October 29th, right before Halloween. Okay, so the October 29 pattern, if technicals were 110% always correct, which in general they are, but of course the timing gets off, we know that. But from a swing perspective, we could have tested a pretty pivotal short-term bottom right now. Okay, so that's what I'm looking at. Saying all that, you could be looking at this as there's your October 29th, massive rally ensued, pulled back, Tried to hold, pull back, massive rally again. Remember, this is the daily chart we're looking at. Big crash last week, pulled up. This was Friday. This was today. So one scenario that could play out for the bulls on the long side. Bear with me 1 second. Okay. Is that and remember, this is the daily chart, so it's cutting out the intraday swings and all the machinations that happen, intraday volatility. Then it is possible that we go back and retest the magnet, which is going break even for 2018, the money management complex, the pension funds, the mutual funds, where mom and pop keeps their money. They would like to be even for the year. The indices would like to be even for the year. So the big push could push us up to 2682. We closed at 2637. That's about 50 points higher from here. 50 points times 7, roughly 350 point rally on the Dow. Very possible. And we're looking at a wider picture, zooming out. We could very well get back towards 2743 and up to that vicious resistance, which is approximately in that 2800 to 2852 level. Remember, every single time that we got to that 2817 level, that's why my charts are the ultimate roadmaps, and we got close to it. We hit it back on early November. We hit it back in October. It's been a massive supply zone. Big time sellers. Big time machine selling. Right at that level. Okay? Right at that level. We call this a left shoulder. Remember, this is a zoomed out daily picture. This will be the right shoulder. So if we go above the right shoulder, let's say, at that point, we will hit major resistance at around 2775. And this is how you got to trade the SPYs. The SPYs are the best way to trade the market. I've been saying it. I've been proving it. And I hope many of you are doing it. I don't care whether you buy one contract, whether you buy 20 contracts, whether you buy 10 contracts. That's the way to play it. It's the best way to play the markets, aside from all those other killer trades that I deliver when the markets are down 600-700 points, whether it be the Aapl, which we're going to talk about today because it had a very pivotal reversal today off a major level. And even the big shots are saying this could be a tradable bottom for another 6, 7, 8, 9 points, taking it up into the 170s, possibly to 180. We'll look at the chart and we'll see whether or not, doable. Remember, the noise is the noise, whether it's the Qualcomm winning an injunction in some no-name Chinese court in one of the provinces saying that they can't sell their iPhones, or at least their older iPhones. It really has no bearing. The stock will act based on technicals. Apple is a very, very technical stock. So anyway, so saying all that, Apple has a big bearing on the markets, as we clearly saw. Apple started to turn. Some of the stocks were already up, whether it be Square or Facebook or Tesla or Netflix. They were already up in the green, going back and forth. Apple was the one which made a significant reversal today, both on the price front that most 99.9% of traders out there will be focusing on. We just don't focus on the price. We focus on the charts, and we're going to look at that too. Apple reversed from 100, for people who were busy today, from 163 went to 170. One heck of a reversal. Remember, this was a $1 trillion company. All right? It's got a lot of weighting. 163 to 170 and closed at 169.11. That's a lot. The calls that I alerted to people on Apple, they were around the $1.23, giving you one series of the calls, which would be the December 14, 170s. They were real cheap. They were around $1.23. They went from $1.23 to $3.25. So on a reversal basis, on an absolute basis, they were up 264%. That means your net profits would have been around 160%. Nobody catches the exact bottom. Nobody sells at the exact top. Even if you're close to it, out of that 164% net ROI reversal trade, even if you got 80% of that, that's 80% that you made in one single day in a couple of hours. nothing to write, sneeze about. There's some serious stuff. So forget about making 160%. Even if you caught 60%, 80%, that's a damn good profit to make. And I walked you guys through it, as you guys know that very well. So saying all that, let's go back to this year. So bottom line is this formation is very clear. It's very clear. This is what it looks like. This is all machine language at play in the form of charts. This is a big hammer reversal. We like that. A nice long hammer, closed right at the top. Futures were down about 12 points when I started this session. They are now rushing forward. They're only down 3. So obviously, there's news breaking out. I'm looking at my Bloomberg on top. It says Treasury Secretary Mnuchin and China's Vice Premier discussed trade this morning. Very good news. We want them to keep on talking, right? We all want them to keep on talking. So that's the breaking news. That's the reason the futures are running. Okay? That's the reason futures are running. I tell you, every time I do these webinars, there's some sort of big fat breaking news moving the markets, Somebody's watching us, guys. Somebody's watching us. So, saying all that, at this point, this is a likely scenario. So we could have a 3-day rally going into the end of the week. And remember what happens when we get to the middle of the month, right? It's almost inevitable that on the 15th, which is a Saturday, give or take plus, 1 or 2 days, plus minus 2 days, there's always extreme volatility. So we could have a 3-day rally taking us into the Thursday period, and I'm walking you through it. It could be a 3-day candle, which could bring us all the way up towards this 2710 to 2743 level. And if it goes to 2743, we're talking about 100 points from here, 100 S&P points. By now, we're so used to these wide vacillations. People would say, 100 S&P points. Wow, can that happen? Well, like we say in New York, dude, it happens in a couple of hours, right? 100 S&P points means 600 to 700 Dow points, and that is quite doable over the next couple of days. Quite doable. All right? So that's one pattern. Remember, you can look at this as or you can look at it as inverse head and shoulders. You can look at it as a W pattern. What it really is a trading range. That's really what it is. Here's the upper end of the trading range. One of the upper ranges. Let's call it upper range 1, which is 2817. Here's your lower range, which is roughly 2600. That's it. And this range move, and by now we should be, we're battle hardened, right? I mean, I've been battle hardened for many years, but I'm just telling you guys who are starting to really see the power of how these markets move and why these charts are so powerful. That's 200 points. That's 200 points means that's 1,400 points on the Dow. So this range here is a 1,400 point plus minus. Oops. Can't write with these things. Hold on. 114. Right? So this is your range. Now what happens in between? Lots of volatility. But that's the wide range that we're traveling in. These ranges normally occur over a period it's plus minus 1,400, right? When it's down, it's minus. When it's up, it's plus 1,400 points. That's Dow Jones points. I'm going to write DJ. Dow Jones. Okay. So now let's do a day count. How long does it take to traverse the 1,400 points from the lows? It normally takes 1, 2, 3, 4, 5, 6, 7, 8 days. How long did it take here? This is the day after Thanksgiving, where we were buying moderately, nobody was around, and the markets gapped open and ran like a monster. This took 1, 2, 3, 4, 5, 6 days. Right? This took after the bottoming. I'm counting this as a reversal day 2. 1, 2, 3, 4, 5, 6, 7, 8. Day counts are very important. One of my old mentors that I went to, actually, the only time I actually went to a stock webinar was, I think, twice in my life, seminars. And he used to do day counts. That's an interesting thing. And this is when I was a rookie, and I was just wanted to find out different things. But it stuck in my head. So so off these 2600 level, it normally takes an average of 1, 2, 3, 4, 5, 6, 7, 8. Here it took 1, 2, 3, 4, 5, 6, 7. So roughly about 6 to 8 trading days it takes to do that. 6 to 8 trading days, 1400 points. That's when everybody just the head's cocked. So you got to be in there at the early stages. That's all I'm saying. You got to be in there at the early stages. You can't be chasing the market all the way here, making a little bit of money, and then getting completely sideswiped and giving it all back and much more. All right? You can't do that. So by now, you know very well that if you're going to trade the range, which as tactical traders, you have to. This is not a market saying, oh, we're going to make new highs, blah, blah, blah. Is it safe enough to buy? Are we out of the woods? Completely decimate those terms off your head. Those are garbage terms. Those are terms used by the financial media to make you feel scared or make you feel good. Like, what do you mean out of the woods? I mean, just imagine this whole market as one long Amazon forest, all right? And you're the hunter going through it. It's not getting out of the woods. Like, what's going to get out of the woods? We had the meeting, which was an amazing meeting, powerful meeting between Trump and Xi. Are we out of the woods? So, think about that for a minute. There's always going to be dangers in the woods. So we're always in the woods. How about that? So you got to get in this range, even if you didn't catch the bottom today, which I told people exactly at the bottom after we did that quick short, which was a nice one. What was it? Around like 22, 30, 40%. Fast moving short. And then the tail reversal, long tail hammer reversal. You got to be, even, let's say, for example, you didn't get in today. Then if we see a continuation pattern, or even if we see a minor pullback, let's say we pull back to 2600 again. That means we give back approximately 200 points. Don't freak out. As long as the range is there, and I keep on showing these charts, it's up to you to decide what you want to do. And the only reason I do these webinars is I try to show people what you need to do. After that, it's your call. All right? You want to be in the bunkers, ordering new diapers from Walmart or wherever, going to running to from Amazon. That's up to you. But I will keep on continuing with all sincerity to try to help people see what I see and then provide my best information that I can analyze, and then you guys take that and do what you need to do. So saying all that, you need to be in this, you need to get into this range, just the way it was back in October, just the way it was right after Thanksgiving, just the way it's happening now, because this is where you make the most money. By the time we get towards these levels here, going back into the 2743 level, which is also a major resistance, and the 2775, the bulk of the move is over. I mean, we could be in this 1400 point range, and I'll make this powerful call for the next months to come. A sideways trading range spanning 1400 points. So common sense dictates that when it gets to the lower end of the point, as long as this range is intact, because we break 2600, then we're looking at another wide range of 2600 to 2500, right? But we're talking about what we're seeing right now. So for now, the tradable bottom is 2600. So 2600 to 2700 to 2800, or even 2600 to 2800, 2600 to 2700, you want to be on the lower half of the range in order to make that money. Because by the time you get in here, they're going to slam you down. And that slam down could be a bull flag, which allows more juice for the markets to break out towards 2800, or it could be a consolidation flag that breaks down for 2 days and then goes higher. That's exactly what this market's full of manipulation. It's complete algorithmic high-frequency trading manipulation. This was a consolidation flag. This was supposed to go up. Well, guess what? It did go up. But along the way, it created this was Thanksgiving week. It created a 2 to 3 day scenic, what I call a scenic detour, or a detour through the the canyons, and then it got there. So if you're a tactical trader, you're trading these charts. You don't want to be shorting these levels here necessarily. You want to be looking for a long trade based very clearly, as we see now, a very defined trading range that I just showed you. 2,800, 2,600. In the middle, of course, there's a round number of around 2,700 here, and then 2,743 is another level cluster where they keep on hitting the market. The rest of it, the news flow and stuff, hey, I could spend hours explaining to you every single bit of news that affected the market. But how is that going to help you? I know. I'm not a I'm not a newscaster. I'm a tactical trader. I define the news in the context. I analyze the news in the context of my charts. Am I clear on that, guys? Jack, Jody? Yes? Okay.
Yes.
All right. Sounds good. So the bottom line is real common sense. Let's use common sense, is we need to be in at these levels. Even if it pulls back a little bit, as long as the 2,600 is holding, then we should be in at this level. And we sit patient. You got to buy time. Don't need to go out weeks and weeks. You can buy the following week because these things are happening fast. Why? Because I just showed you the day count. You got 8 days. You got 6 days, 6 or 7 days. So it's not like it's taking 8 weeks. So you want to put your option strikes within that period. So you want to buy an option given the fact that there are options on Monday, Wednesday, and Friday. You want to at least have 7 to 10 days under your belt because that's what's going to happen within the 7 to 10 days. If it's getting closer, as the numbers are being taken out, for example, I told people to buy the 260, 61s. And then I said, roll them out. 264s, 266s. You got to roll them out as they're moving forward through those levels. You don't necessarily need to sit on that same call that you bought down here. Because that doesn't make any sense. You want to roll over. You want to keep most of your profits, buy a cheaper call with a similar premium left in it, 5 to 7 days, 7 to 10 days, and you let it go. Is it that easy? No. Is it smart? Absolutely. That's how you do it. Want to get into the nitty gritty of it? Exact trade management. Sign up for the ACSs. I'll be more than happy to spend my time explaining that to you in detail based on your own criteria of what kind of trading capital that you're trading with. I'm not an advisor. I'm not a broker. I'm simply going to suggest on things which might be helpful to you. That's all. All right. So now, what's the other thing that we see here on the daily, which is very simple? Keep it simple. We see multiple bottoming processes on the stochastics, full stochastics. We saw a bottoming here right the day after Thanksgiving, Friday. We saw it today, and it was developing since Friday. So today we saw the crossover. Now, is a crossover a guarantee? No. Is it worth trading? Absolutely yes. This crossover has to be respected. Why? Because the rest of them all worked out. That's what you call, this one took 1, 2, 3, 4, 5 days. So this is a short one. It still went. I drew this line here because that is the mid-level line of an RSI of around 15 on the stochastics. Sorry, 45, because once it crosses over there, you don't have to look at the numbers. But if you look at this, once it crosses over there, there is a spring forward. By the time it gets to the stows at 45, that means we should be above 2018 break-even levels. That's over 2682. That's roughly about 300 points up higher from here. But as long as the crossover continues, you want to be long that trade. It does not mean that you're not going to take in some nice profits intraday because you bought low. I'm simply saying if you want to leave something out for the next 10 days or so, remember 10 days is 2 trading weeks, 5 days a trading week, right? Then you need to keep an eye on this. And as long as it's flowing, you want to be a net buyer till it gets overbought again. It's really that simple. Okay, So that's your daily. Now, one of the other things I noticed from a pure technical standpoint, so this is excellent. It's got real oversold. Didn't quite touch the lowest bottom, but did its job. Panic lows at 25.80, massive reversal. Let's not discount today's reversal. This was one heck of a reversal. And every time that one heck of a reversal happened, the market generally had a follow through for multiple days. So let's not just brush it away. Now, one of the things I noticed was the Aapl curve, and look for the definition of the Aapl curve. Bear with me one second. Please look for the exact definition of the Aapl curve. It's a market directional curve. If I said Mr. Aapl, I don't think he's around anymore. God bless his soul, okay? Is a massive positive divergence. We hit the same level that we were at on October 29th. The Aapl was in the gutter at minus 10 or below, right there. We hit the same level of October 29, which is that 2591, 2605 level. The Aapl curve is at minus 1.61. That, ladies and gentlemen, is a positive. I'm going to call it plus div, positive divergence. It is showing you that the real underlying strength of the market overall, the directional bias of the market has not changed. The Aapl, given the fact that they both hit the same levels, should be down here, right? But no, the Aapl made a higher low, much higher low, and the market hit the same, and even below that, made a lower low compared to 1029, October 29. That, ladies and gentlemen, is a positive divergence, which is glaring, and that's why I put it out here. No more to say about this. Clear as day. Does that mean something? Sure it does. But you won't know what it means till after the fact it happens. I've shown positive divergences repeatedly in multiple things, and they've all worked. Maybe they take a little bit longer, not weeks. Maybe I'm off by 2 days or 3 days, but they work big time. Okay? So let's go back to the shorter term charts. I mean, I have nothing to say about this. I zoomed into the charts so that I don't have to go all the way back, so that you guys can focus on the Fibonacci retracement of 50%. By now, you all know that the 50% Fibonacci on any type of massive drop in the market or rise in the market is where the market gravitates to. Read up on the Fibonacci retracements on investopedia.com. Please do. Remember, we were playing the head and shoulders. This was supposed to be the right shoulder. It was the right shoulder till we broke down on that on Friday. Guess what we did? We came back straight up to that right shoulder today. So we took a one-day detour. Did it change the world? No. No. So anybody who panicked and sold everything basically lost out. Again, you lose more money in these type of markets, honestly speaking, by not being in a trade than getting out of a trade. I can assure you. You can calculate that. So saying all that, the 50% retracement now has been adjusted down here. Why? Because we went lower. So I took I adjusted the fib, and you can play around this on your own charting platforms too. The 50 fib right now is at 2698. Call it around 2700 on the E-minis. This is your 23.6 fib. That is exactly where we stopped at, or slightly above that tonight. This big green dotted line is where the markets want to go, whether it takes a scenic detour or not. The markets could very well do this. Comes down again, freaks out everybody, and then does this beautiful Texas bullhorn pattern. That's a Texas bullhorn pattern, okay? Known as a power inverse head and shoulder, breaking out necklines and going crazy. This big drop will be replicated, ladies and gentlemen. And you know by now, who have been with me for many months or some months, when I say these things, I'm no genius, but they work. Is it possible that we create another double bottom at 2600 to retest it? Absolutely it can. Absolutely it can. It doesn't necessarily have to hold 2635. And 2635 is just around the corner because this is at 2648. So 2635 is something we could wake up to. We're actually there right now. We're actually there right now. After market, the futures are down about 9 points right now. They've been going back and forth. So we're actually down here. I don't know why this hasn't adjusted yet. Let me see. So it's showing 2632. Oh, 2632. So down here, I'm sorry, it's 2609, 2609. I don't know why it says 2634, but when I put the cursor here, then it's showing me 2610. So is it possible we drop another 15 points, which is roughly another 90 to 100 points before we move forward? We certainly can. Key is just to trade these charts just the way they're built. So this is the big crash from the 2800 level. So let's zoom in. Let's forget about this level for now. We want to zoom in and use the 50% fib as a magnet. That's what we want to trade into. That's what we want to trade into. I'm using this as a possible max upside, as we like to call it. Big bullish news, Donald tweets out, President Trump tweets out that, hey, everything's going well. I really like what they're talking about. Markets take off like a rocket. All we're basically saying is we want to get towards 2,700. Short term, over the next couple of days. 2,700 is very doable. That's your 50 fib. That's why I zoomed in. Now, these are extremely volatile markets. They are not your standard definitions of what these standard technicians talk about on TV. You see the charts they show. I mean, they're just like, it's like drawing things on the back of a napkin. What I'm showing you is breaking apart each piece so that you guys know where the pitfalls are and where you can buy, where you can exactly sell. How come you never see these charts on CNBC or other financial media? Think about that for a minute. Somebody's saying you should basically send it to them. I actually don't want to. I don't want the public attention. I want the attention from my loyal members who bring in other members. So we keep on doing what we're doing. Because these are the real charts, guys. You know that. Not the little frisky ones that they show on the big screen on CNBC. Even though some of the guys are very good. They'll explain it. But they make it so simple, it's not even funny. How do we trade those things? These are the charts you can trade. So this is where we are. Nothing more to say, okay? Let's look at the 1 hour. This is where we are. So now we're cutting out the 15-minute noise. This is more legible. This is closer to looking at the daily that we analyzed just a few minutes ago. Remember, these volatile markets, they're straight line up, straight line down. 90-degree angles. These are 45-degree angle moves. This is a 90-degree angle move. That's why I always said in simple terms, the faster and uglier it gets, the faster and furious it's going to move to the upside. Equal and opposite reactions. I don't need to prove myself. I've been showing this for years now, but more so now because of the speed and the velocity of the movements. So let's look at this. Again, another very detailed chart for all of you guys to trade. I update them every 15 minutes. You know that on my Twitter feed. All you got to do is take a look, and all you got to do is get in the trade as needed. If you're all waiting for some perfect moment when things are just going to be that easy, it's never going to be easy. Hey, I'm a straight shooter. It's never going to be easy. Is it going to be extremely hard? Yeah, only if you keep on chasing prices, keep on blasting out. You buy these levels, you're extremely happy. Many of my traders are extremely happy. So there's really nothing to show here. All the levels are put out there. This was the big break on the Fed Chairman Powell speech. The market basically tried to make a stand here before it fell apart. Because this was supposed to be where the market would have tested out this breakout level and moved from here, but then it held here, sliced down, and now it's heading back towards that level. This is the huge downtrend line. Remember, downtrend lines are tough to break. That's why every time we went to resistance, downtrend line, we failed. Once it breaks out, after the third attempt, it should normally break out. This was the first attempt, second attempt. On the third attempt, it generally breaks out. So where it goes after that, every single line is put in place. Get used to trading these charts. Get used to looking at them. There's really not much to understand. It's just lines and levels. That's it. Now I can see a wide pattern. So if you want to cut out the intraday swings, buy something 10 days out, add to it as needed, but don't follow every single 15-minute chart or volatility craziness that's going on. There's a high probability that as long as the 2580, 2600 holds, that the markets will get back up towards here. That might take a little bit longer. Short term, it is going to go here, and then we'll see what happens. And we'll see what happens from this level. Because once it breaks out of here, there's a good shot that the markets go to 2772. Is it possible it recaptures back where we were back on November 8th? Sure it can. Sure it can. It's done it before. Now, along the way, there's a lot of detours, a lot of 50, 100-point drops, 200-point market opening, gap down openings and stuff like that. But as long as you keep an eye on this chart on a swing basis, and you keep an eye on the daily on a swing basis, you're in a good spot. You're in a good spot. When this wide channel uptrend will start, we don't know yet. We don't know yet. Now, this is your spies. People are trading spies. If I just put this one chart 4 times a day, I think I've earned my keep on the few dollars that you guys pay me on my member subscriptions every month. That's serious. This one chart alone is all you need. Aside from the other ones that I built today, it's called the Ultimate Trading Charts, which I'm going to go into next. You give me some extra for that every single month, right? I'm serious. This is the only chart that you need. And I want to say it again. We are the only service out there. I think we're the only service out there who walks members, traders, active or semi-active, day or swing traders or long-term traders through this detailed moves and levels through the market. So you see a clear picture and cut out all the noise and garbage that you guys hear out there, or even looking at it when you look at your own charts. So this is very defined. It's very defined here. As long as we hold the 258 level, 258 whatever, 60, you can see that. This was where we came down to on again October 29. We're using this as a major reference point. As long as this big red line holds, and remember this was a slippage, and that caused a coil spring bounce known as a hammer reversal with a nice long tail, right? You saw that. Then we call it the 3 marching soldiers. It's actually a technical term. You can go to Investopedia and type it in, and then this is where we are. Generally speaking, that's a very positive finish. But like again, because of the crazy Globex volatility, we could very well open down here. But as long as this level holds, then we should be able to bounce all the way up to 271 where we were at, and that's a nice move from 262. From 260, well, below 260 when I said buy, and at 264 to even 271, that's a very decent amount of money. We were there on the 7th. On the 7th. What day was the 7th? Holy God, 7th was a Friday. I'm losing track of dates. We were here on Friday. Okay? So why can't we go back to where we were on Friday? Exactly. They're going to remember, the markets and the business are throwing you out of a trade. The news is going to come like crazy. There's going to be Brexit, there's going to be all kinds of stuff. All of a sudden, the Italy bond market will show up. All of a sudden, all kinds of, stuff will happen. But the reality is, you got to focus on the charts, keep the news at the back of your head, read some of the comments and a quick analysis that I put through. I'm pretty good at analyzing that type of, complex news that comes out. Make a determination. Like I said, if they push out the Brexit thing, the markets are going to rally. From a business standpoint, they don't want Brexit. Okay? Just remember that, because it's going to disrupt major business. I'll mention one thing which is the truth why this whole yield curve inversion is happening. That's my opinion. I'll say it at the end of this session. They should say that on the national media. Everyone's yield inversion, the U.S. economy is going into recession. President Trump is doing a terrible job. None of that garbage. The yield inversion is happening because, ding, 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 wait for it. I'll mention it. That's my opinion, and I'll say it at the end of this session why that is going on. It has nothing to do with the U.S. economy. The U.S. economy, yes, does not like a prolonged trade war, but U.S. numbers are still pretty damn good. Rates have dropped substantially on the bonds, on the long-term bonds. Remember, we were falling hard because rates were going higher. Now we're falling hard because rates are going lower. And there's a reason why there's an yield inversion going on between the 2 and 10 year, and the 3 and 10 year, and the 5-year and 10-year government bond deals. So, saying all that, you look at the pattern. All right? So you got to play it. This is positive. The MACD. Anytime there's a crossover, MACD histograms were positive despite the fact that we went lower. That also is a positive divergence. This is your actual S&P, similar to the E-minis. Positive divergence on the Kapok. If the Kapok breaks down, that's a different story. But the Kapok is now making a higher low versus prices which made a lower low. This is what the Kapok was. Shouldn't the Kapok curve be down here at the same price level or lower? Yeah, it should, right? In a perfect world? No, it's a positive divergence. That is good on a directional bias on the market. We have confirmed crossovers for now, right there. Every time the markets crossed over, we had generally had a multi-day rally. Saying all that, repeating it again. We could open down 10, 12, 13, 15 points lower in the S&P, but as long as this holds and this keeps on curving higher, you want to be long, or you want to be looking to buy the dips. There's your VIX. I don't want to overanalyze this, but the VIX is a wild beast. My quick read on this is this massive downtrend line is acting as a major resistance. This was a very long tail reversal, inverted hammer right there. What day was that? On the 6th, on Thursday. That is still a valid one, because whatever the VIX did throughout this 700-point drop today earlier, and then on Friday, just, what was it, 800 points, before we moved up, and ended the day at 560 points down on the Dow. Big numbers. How come the VIX didn't make a new high? That is called a negative divergence. You didn't make a new high, despite the fact the markets were down 1,500 points net from Friday till the bottom today. Almost 1,500 points on the Dow. So how come the VIX didn't make a new high and go all the way above 26? My other VIX charts are also very clear, the Algo HFT ones that are from the Quad platform, and I highly suggest you guys take a look at them when I post them, or even take a look at them before you go to bed. My first glance when I look at this chart, based on the fact that I'm looking at my S&Ps and all that stuff that I explained to you, is that this one is, yes, it is still in that W formation. It could still break out when we slip and slide. Let's say we retest 2600 again, the VIX will break out. As long as this doesn't make, as long as the VIX, look at the internals. This is your internal. If this starts to curve down, this is just the opposite of what I explained to you on the actual market. If the VIX full stows, stochastics, keep on sliding down, and the VIX makes a new high, a slightly new high because of the intraday volatility, That is a negative divergence. That tells you and me that the markets will go higher. If the VIX stows keep on sliding down and the VIX makes a slight breakout over the downtrend line, as you can tell, it's just the opposite of a positive divergence. It's a negative divergence. So this one is, for now, that's not necessarily a very bullish candle. Neither is it a very bearish candle. But you couple these two, and if this keeps on sliding, the stows, and this basically does a green candle here, generally means it's going to maybe break out a little bit and then pull back. Or if this turns around and goes all the way higher, then it gets really overbought, that means the markets will fall another 300 to 400 points and the VIX will basically try to head towards 27 plus. We don't know yet, but so far so good. It hit exactly the downtrend line. You know, these charts can't get any better. This was a downtrend line that went back all the way from when the VIX was 50. That was back in February. We're back to February levels. Think about it for a minute. This was February, right? Feb 9th, Feb 6th, whatever. The VIX hit 50. We're back to that level on the markets, on the S&P 500, right? Back to the Feb 9th level. Look, right there. Right there. That's where we came down to today. So how come the VIX didn't go to even 30? Where's the VIX? How come the VIX didn't go to 30? That is simple common sense. We went down to the same level in the market where we were at. The panic shot it to 50. Okay, there were some other technical reasons behind it. It was called a vol trade. Hedge funds blew up because they were shorting the VIX. But why didn't it even go here? How come it didn't go here? Forget about going there. Because the VIX hitting here at a measly 23, while the markets hit the same levels where they were in February when the VIX was at 50, you tell me if the market's trying to tell you something. I'm going to quickly scan through these other ones. These are the charts I constructed today based on short-term movements. 2,700 here. This was the level back on the 5th, which was Wednesday. It's a very geometric chart, very clear. This, ladies and gentlemen, is a bear flag. That's what a bear flag looks like. You get a big drop. One second. You get a big drop. Basic technical chart patterns, and then it generally tends to fall below. Again, well, guess what happened? This was a bear flag, and we opened down. So the bear flag was constructed and worked. This was the bear flag from the 9th, which was over the weekend. The futures were rallying. Bear flags generally stay on its primary trend lower, right? That's exactly what we did. That's why we initiated the short that worked out very nicely, not in the hundreds of percent, but around that 40+% range, 20 to 40% range over a matter of half an hour earlier on. And right from there, long tail reversals, and this happened. We are back in the bear flag. That bear flag would be decimated. In other words, the short-term downtrend would be negated once we cross over this level over 2660, which is 16 points from here. Multiply that by 6 on the Dow. That's roughly another 100 points in the Dow. We are out of the bear flag. Once we're out of the bear flag, you know the levels we're going to engage. It's all there. This is one of the ultimate trading charts. You don't need to overthink anything. Just need to keep your eyes open and just trade these levels. That's your 15-minute one. The next one that I constructed for all of you was the SPY 1 hour. I think SPY 60 minutes. Let me see. Yes. No, the SPY 15 minutes. Again, we are within that bear flag. We would like it to break out. Once it breaks out, it's going to go to 267. If it falls below into the bear flag again, we're going to come down to 263 and possibly attempt to move from here. So if futures, which are now down again 11 points, Globex futures are very frisky, then we could come down, retest the lower end of the bear flag, possibly even break down. So we have to be prepared for all instances. As long as the 258.60 level holds, we will bounce. That's it. Dow Jones Industrial Average, what can I say? Another fantastic chart, Fibonacci retracements. 50% fib is 25,416. That's 100 points higher from here. I'm sorry, 1,000 points higher from here. Will it get there? If it was pure if technicals purely dictated the market, yeah, it'll get there. In between, there are hurdles. There are the resistances. There's a gap fill here. All kinds of stuff. Get used to looking at this chart. This is important for people who trade the DIA. There's your, yeah, that's your diamonds. The Dow diamonds has to be respected because look at the length of this channel. Huge. I didn't recommend the diamonds today, but I did recommend it last week. I'll revisit it again tomorrow. That was a very large move. It was from 239 to 244. That's a lot. That's what happens when you get a 600-point move on the market from the lows. There you go. Very long tail. Has to be respected. Has to be respected. Right there. So again, that's another Fibonacci retracement. You want to trade these DIAs. They're beautiful instruments to trade because the Dow's so volatile. You want to be in that. These things are cooperating. This is a daily, so it carries more weight. This is nice. Last time this happened, big time moves happened. We shot through the downtrend line, and then the big sellers came in. This downtrend line is where, in my opinion, it wants to go to on a big move again on the Dow. And that's talking about another 1,000 to 1,200 point move. Once it breaks that, then that's a different story. But this has to be respected. Now let's take a look at Aapl. So Aapl, I called it right there. Aapl has, this is, again, it's a Fibonacci retracement chart. Here's Aapl at the bottom where I drew the fib. This was back from February 9th. Feb 9th. Don't forget, that's the day the Aapl turned. That's the day the market turned. No coincidence, right? Feb 9th. S&P 500. Look at the date. February 9th. 2-9. Just remember, 2-9. 2-9. Aapl. Another hammer reversal. 2-9. Coincidence? No. Just mathematical correlation with the markets. Feb 9th. Sparked off a big rally. Of course, chopping back and forth. The big rally came back and retested slightly higher, positive divergence, and then started out. So forget about what happens here. I'm concerned about what happens over the next week. So if that's the case, it's got a good shot to go to best case scenario, 50 fib right there. And Appl's another stock. Options are reasonable. Look at the Aapl calls. The 167.5 that I mentioned went from $2 to $467. Can't beat that. Almost 150%. 2 to 5. Almost. The 170s went from $1.23 to $3.25. Sweet. And we talked about that earlier. So bottom line is Best case scenario, Apple gets up to the 55th. That's a lot. That means Apple would rise 22 points from here. So forget about rising 22 points. Let's look at this gap here. That's 185. Let's look at the lower gap, 181. Let's look at another gap, 175. So if you trade Apple from 169 to, let me clean this out. So you see the correlation, Feb 9th. Apple hit rock bottom. Look at the stows. We never got to those levels. On Feb 9th, it was at 149.39. We moved from what was Apple's low today? It was 163. So we are at 163. That's a positive divergence too. But look what the stows did. The stows created a big double bottom at the same level of 0 like it did back on Feb 9th, 2.9. So that's a positive divergence. How come it didn't go down to 149? The bears would tell you Apple should be at 149. The dogmatic bears. So it didn't. It created a higher low with the same capitulation oversold conditions on the stows. That's a positive divergence. The first level where the gap where Apple was on the 6th was Thursday, was 174.89. 174.89. I'm talking right here. Right there. This gap is basically 175. This gap is 177 to 175. Guys, or ladies and gentlemen, who's going to be listening to this, okay? Apple going from 163 at the low when I called it, or even from now, let's see if they get a chance to get in. If it goes from 170 and it goes to 175 and just closes this gap at 176, that's a lot of money. Forget about getting up here. If you played your cards right and Apple actually went to 191, let's say over the next couple of weeks, we don't have that much time left for December. Let's say over, whatever. Let's say it goes over a month's time between now and in January. You could make yourself a fortune. And it will simply come back to the 55th. Right there. So I'm not even going that far. I'm going to the gap fill here, 175 to 177, and possibly to here, where Apple kind of stalled and just crashed, of 185. All levels are shown on this chart. Apple should be on a radar screen. Because now, because of today's reversal, it's showing up a lot in all the big quant technical traders who are seeing this as a bullish event, and we called it right off the bottom when the candle wasn't even green. That's it. All right. So the last thing that I was going to say was my feeling as to why the 10-year bond, and let me just pick this up here, did that inverted curl inversion on the yield curve is because a lot of money, because of this Brexit crap going on in the United Kingdom, serious stuff actually. That's your IWM. Let me put it the TNX. So here's your TNX. It is at a pivotal level here. Look at that, very defined. The reason why the yields collapse, because remember, prices are inversely correlated, opposite to the yields, right? So as money flows in and hides in safety, and the safest asset in the world instrument is the U.S. Treasury bond, as money went in hard into the short-term Treasury bond, especially, which is the 2-year bond, and the 3-year bond, and the 5-year bond, which is the FVX, and it collapsed like this. Let me show you a daily. Let me give you a quick bond lesson here. It's very important for people to know. It collapsed from 3.1% Remember, it's not 30.95%, right? You move the decimal to the left 1 point. Interest rates, yields on government bonds are not 30%, in which case we'd be in a disaster. We'd be living in the caves right now. So from November 8th, which was 1 month ago, it went from 3.1%, I'm just rounding off the decimal, to a low today of 2.67%. So let's do the math here. 3.1 bear with me 1 second. 3.1 minus 2 point. The yields collapsed 13%. The rate of change was very fast, very furious. From here, in 1 month, yields collapsed on a percentage basis. Yields went from 3.1, roughly, to a low of, what did I say it was? 2.7? What was the low today? Yeah, 2.7, rounding it off. 2.7%. Okay? So that's a drop. It's like a stock going from $3.10 to $2.70. Might not seem a lot, but a drop of 0.40 percentage point means it dropped 13% in value. So when this happened, the 13% yields fell 13% in 1 month, inverting the yield curve. While prices shot up, because remember, price on bonds, I've explained this many times on my videos, you can look through the ones which explains the bonds. When prices go higher, yields fall. Okay? Now listen carefully, this is not rocket science. Basic economics. Why would the price of something go higher? Because money's flowing into it. Why does the stock price go higher? Because more buyers than sellers. So why does the price of a bond go higher? In this case, we're talking about the 5-year treasury bond. Because money flew into it. Why would money go into a safe haven in the midst, and I believe that the nature, they didn't put money, the collapse on the 10-year bond wasn't as dire and as fast and furious as this one, which fell 13%. Rates fell 13% from 3.1% to 2.7%. This is my opinion only. And I think I'm right. Because a lot of global big money, European included, went and hid in our 2-year government, in this case we're talking about the 5-year, the 5-year bond in safety. They don't care if they make 2.1% and not 2.7%, not 3. They just want to sit there because remember, that's the safest asset in the world. The U.S. government has never in its history defaulted on U.S. Treasury bond interest payments. So because they rushed in because of all this Brexit uncertainty, primarily Brexit uncertainty, in my opinion. Not the China stuff. That's been going on for months now. Brexit uncertainty in the United Kingdom, in England. They went and hid in our 5 years, in our 3 years, in our 2 years. Short-term paper is why the prices shot up like a rocket and yields fell. And all of a sudden, every single bozo out here who wants to talk down the U.S. economy, who want to basically demean the accomplishments of the U.S. government and the Trump administration business team, and I've said this before, are saying we're going to go into a deep, hardcore recession. For what? The U.S. economy, in my opinion, is not going into a recession. This yield curve inversion happened. That's the last thing I'll say in this webinar. Okay? So you want to sound small with your boys having a couple of beers and having a couple of drinks? The yield curve inversion happened because a lot of the big European money and the global money, scared of Brexit, pulled out of their stuff and came in and hid in our 2 and 3 and 5-year paper, which is 5-year bonds. They went in that. It caused a short-term disruption. The prices shot up as more money went in, and yields got depressed. The rest of the hogwash that the U.S. economy is going into a deep recession, blah, 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 because the yield curve inverted, they never tell you the real reason behind the yield curve inversion. You heard it here first. On that note, guys, see you guys all tomorrow. We'll have a great week. God bless you all.